Hi everyone. Today we're going to talk about Uber. Now, I'm sure everyone watching has heard of Uber, but in this video, I'm going to analyze Uber as a stock investment. The usual disclaimer is this is all my opinion. None of it is investment advice, so on and so forth. So Uber, as of last Friday, traded at $33.40, making it a 55.3 billion enterprise value company. What's interesting about Uber is that it was founded in 2009, but it didn't go public until 2019. So it waited about 10 years to go public. And in terms of how it makes money, 62% of their sales come from US and Canada, and the rest from Asia, Europe, and Latin America. A further breakdown of their business can be, you can break it down into three segments. There's the rideshare segment. So in 2019, they booked $13.5 billion in total fares. And of that, Uber claimed $3 billion in revenue. So if you're like me, I always wonder what is Uber's cut of our fares? That's about 22% on average. And that's 76% of their revenue in 2019. They have their Eats business, which booked 4.4 billion in gross bookings. Of that, Uber's cut was about 17%, coming out to $734 million. That's about 18.5% of their total sales in 19. And they have a tiny freight business, Uber Freight, which is only 5.5% of their revenue. So moving on to investment thesis. So in reviewing their business model, I actually think Uber has a very strong and robust business model, because compared to the industry which they've disrupted, that is the taxi industry, I find that Ubers are cheaper, they are more transparent, they're more convenient to use, and the cars tend to be cleaner and newer than taxis. So all that's to say that Uber is a tremendously value-adding service for the consumer, for a user like me. In addition to that, Uber is also theoretically a very asset-light business, because Uber is a business that's just a platform that allows drivers to connect with riders, right? And it's basically a platform kind of like Amazon's third-party seller platform, connecting shoppers to third-party vendors, where it just sits on top of other people's productivity and it just takes a cut. It just takes a cut of that. So Uber doesn't need to have its own fleet. It doesn't need to worry about maintenance or gas and insurance, things like that. So it should be, technically, it's a asset-light business. That's usually, I like those types of businesses. And it's a business that is tremendously value-adding for the end users. And that's also good. Now, my second thesis is that I think that Uber will emerge after the pandemic much stronger and more dominant, because it will be one of the main survivors. Let me elaborate a little bit more. So in 2019, I remember in the rideshare landscape, there were so many competitors. There's Uber, Lyft, Juno, Via, GM has one called Maven, and many others. And I think that with the pandemic, you'll see that a lot of the weaker rideshare competitors are simply not going to survive. In fact, Juno has already shut down. GM has announced that their rideshare service will shut down. Maven. And I think Via is probably going through tough times because they specialize in kind of carpooling, and you can't carpool. So I think Uber will be one of the survivors coming out of the pandemic. There will be less competition, and as a result, they'll be stronger and more dominant. Finally, I think that the cost-cutting measures recently enacted by Uber is a step in the right direction. They've announced basically they were back in May that they're going to lay off about 15% of their workforce, shut down a ton of office sites, and they're expected to save about $1 billion in costs. All of that, I think, is extremely positive, and that's a good segue into some of the main risk factors for Uber. So number one is the kind of elephant in the room is that Uber, as it stands now, is an incredibly unprofitable company that not only doesn't generate any cash flow, actually has a ton of negative cash flow. It means they actually bleed a lot of cash every year to the tune of about $4.2 billion in the last 12 months. And obviously, the fact that Uber has any value today is just indication that a company's value is not its historical cash flows, but the present value of all its future cash flows. So that's to say investors expect at some point in the future Uber will be profitable, right? But I think that timing is quite uncertain, and it's really subject to kind of execution risk around how good is their management at really digging down into the operations and executing on these cost-cutting measures. We see that they are moving in the right direction. Even back in June, which was only a month after their cost-cutting was announced, their OPEX has already gone down by about $500 million. I expect to see a similar trend in Q3, and we have to see if they deliver on their promise to cut a ton of costs and really optimize the business such that it's actually profitable in the future, right? The mitigant to the horrible negative free cash flow generation is that the valuation for Uber is actually, I would say, not outrageous. So at $55 billion, now remember, Uber is of the $55 billion, about $10 billion is Uber's investment in Didi, which is the Chinese Uber, as well as Grab. So if you exclude that, what we think of as Uber, that's Uber Eats, Uber Rideshare, is only about $45 billion. And I don't think that's an outrageous valuation. Now let's look at some of their peers. I can only find two true peers that are publicly traded. That's Lyft and Grub. Now Lyft is a much smaller company, 4.7 billion enterprise value, also having an absolute horrible year, right? As you expect in the pandemic. Not many people are doing ride shares. Now Grub, you would expect to be doing much better because of the restaurants being closed and a lot of people ordering out. But for some reason, it also doesn't generate really a lot of cash either. So the second investment risk I want to talk about is around Assembly 5 and Prop 22. Now, this is a regulatory risk. So Assembly 5, quickly, is just California's measure that tried to force companies like Uber to classify their drivers as full-time employees. Personally, I don't think that makes any sense because their drivers don't have to show up for a set amount of time. You can choose to drive Uber whenever you want. And secondly, Uber doesn't prevent you from using rival apps like Lyft. You can, imagine if you're a full-time employee of one company and you get to also work for another company. It doesn't make much sense, right? So Prop 22 is the measure that companies like Uber and Lyft are supporting, basically, I think, to overturn the Assembly 5 measure. No matter how it goes, there's a lot of regulatory risk around, almost like political risk around these measures because, one, Uber has to spend a ton of money to fight these measures. And two, it can set a precedent where for some of the more progressive cities, like if it passes, in San Francisco, it can go to like New York and things like that. So that's something definitely to watch out for, and know that it's kind of always a cost for Uber and Lyft to kind of fight these I would say government measures to basically stifle innovations like Uber and Lyft. So in conclusion, I think for Uber, it truly is, in my opinion, a bit of a speculative stock because I can see such a wide range of outcomes for this stock in the next, 6 to 12 months, depending on factors like regulation, even the elections, and kind of execution. Most importantly, execution of their cost cutting, so that it's actually going to become profitable as a business, right? I think I can see this company being it can easily be a $150 billion company or, $100 billion company in the next few years. But on the other hand, you have very little margin of safety because as it stands right now, Uber is a company that bleeds cash which means it's value destructive. And if it was to continue doing this into perpetuity, it's obviously not going to exist. It has a value of zero, right? What's interesting is that if you invested in Uber right now, you're actually paying about the same price as the Series E investors. And you're definitely getting a much better deal than what SoftBank got, because SoftBank invested in Uber at a valuation of like $49. And even in the Series F round, they had a valuation of 39.6. So definitely Uber hasn't really gone anywhere as an investment for SoftBank. But yeah, so that's kind of my thoughts on Uber. I think they're reporting their earnings next Thursday, and what I'll be watching out for specifically is I'm going to take a very close look at their P&L and see if their OPEX has seen dramatic improvement. Obviously, their revenue probably won't be that great because of the lockdowns, the fear around COVID. But I do expect kind of growth in their Uber Eats business that will help offset some of the drop from their rideshare business, right? So, but most importantly, it's really seeing if these cost-cutting measures are being executed upon and realized. So yeah, those are my thoughts on Uber. Let me know what you think about the company. And as usual, it really helps a lot if you subscribe. And thanks for watching.